why this is happening. I'll explain that as well. So if you look at the world history from 1200 year till 1900 year, for a 700-year period, the world history expanded just by 1%. Just 1%. For 700 years, the world GDP growth was just 1%. In India, from 1900 to 1950, world GDP, Indian GDP expanded by 0.001% only. So from 1900 to 1950, we haven't seen any growth at all. So you speak to anybody who's like people like grandfather's age, they will tell you कि हमारे ज़माने में महंगाई नहीं होती थी because there was no GDP expansion in old days. What has happened in the Western world and in particular in Gulf countries is that when the arrival of Christianity and arrival of Islam had changed everything for them. So they said, today the new God arrived. So they erased all their collective history and memory. So that they said that what you were doing in past was very bad and what we are going to do, something is new going forward. So they lost out their all collective wisdom at that time. And that is the reason that there's no continuation of civilization. So in Europe, from around 2000 years back, we have the Christianity, and in Islam, we have around 700 common era, we had the Islam invention. And what they have done is they completely erased the old history. And that is the reason that in these countries, gold is not a very cultural thing. In India, the gold is very cultural because India perhaps is the only country beside China where there's a continuation of civilization for 5,000, maybe 3,000, maybe 4,000 years on continuous basis. So a lot of collective memory, and that collective memory is not limited to where we invest. So our love for gold is partly that, because it is so much instilled in our culture, our religion, our day-to-day life. The gold has become a very important thing on every social event, almost every social event. That is not the situation you will see in various parts of the world. Till the arrival of Britishers, India and China was the world leader producer of GDP. And why it is so? Because at that time, the country with the largest landmass and the country with the largest population was the world leader in production of GDP, because that was the mean of production. Human effort, physical human effort was the mean of production. And that was the reason that these two countries were leading the world GDP. And that's why the reason that India was known as Sone ki Chidiya, because we could produce anything and we could sell out to anybody, and then we bring gold in the process. And that is the reason that our temples and our various kings and queens had so much gold at that time. Then the Renaissance happened in Europe, and then Europe had the scientific inventions of various kinds of scientific invention, and that led them to start colonizing the world. And that is the reason we have seen the influence of Western world from 1500 to 1600 century, and they start colonizing. So Spain colonized, Dutch colonized, Britishers colonized, various other countries, Portuguese colonized various parts of the world, French colonized various parts of the world. So we have seen that kind of process, and these countries took huge advantage of any accretion in GDP accruing to them directly rather than to the country which they have colonized. So that was the one phase which got what. Then we have the America coming on way, and America is I'll explain you why this country is so different from any other country in the world. So with America's discovery and the new civilization in America started taking lead, and the British started falling apart. The empire where the sun would never set is now become a very small, tiny nation today. And then with the invention of all these things and a better healthcare, what we have seen in the world is that in Western world, which now consumes 70 to 80% of various consumption items, we have seen the rise in income level. That rise in income level led to a situation where they could no longer afford to pay the kind of salary and wages their citizens were demanding. And there was an urge to clean the cities and go out of the polluting industry. So at that time, they were looking at a part of the world where they can transfer their low-cost manufacturing and low-skill manufacturing and polluting industries. So first they started doing with Mexico and Taiwan and South Korea, but they were a very small country. And then around 30 to 40 years back, China came on the way. So China's rise in the world supply is not because of China alone, but also because the whole world wanted a place where they can transfer their lowest skill repetitive job, and the place where they can look at mass production transferring the polluting industries. So that is what has happened. India also joined the bandwagon, but India, I'll tell you a little later about what we lost out in India and why we are struggling today with the GDP expansion and falling corporate profit and the challenges on unemployment today we are facing today. So that is what has happened. But the COVID has changed many things. It is a one kind of event which I think realized Western countries that no longer they can afford to completely rely on China. There's a huge regret cost in Western world today, including America, Australia, New Zealand, that we cannot produce PPE. We cannot produce tissue paper at the scale that we wanted. Now, many of these industries are going to get reversed, and the China, as I see today, over the next 20 to 30 years, perhaps will remain a leader, but it will not able to dominate the way it has dominated the world supply chain. Going forward, you will see huge transformation in the world supply chain as we go along. As I told you, for 750 years, the Indian GDP expanded minuscule, world's GDP expanded minuscule. The only place where one could hoard wealth was gold because it was very easy to transport. You can wear it and just go from one place to another place because people used to get displaced very easily. So gold was become very convenient and you could exchange for anything, any point of time. And then when something become economically useful, then over a period of time, people started getting that become part of us, our daily day-to-day activity and get ingredient into our social, cultural things. So that is what happened to the gold. Property prices never used to go up in India during those periods. People used to buy property for actual uses. So people buy property, land to cultivate it or to put a plant or factory, house to stay. But very rarely people used to put investment, big investment in real estate for gain, which started happening post 70s and 80s. Then we have seen big debacle in real estate, which is going correctly right now. And there's a big inflection point in the real estate as well as we go along. And I'll explain you, if time permit, what will happen to the real estate as we go along. During the entire thing, people start figuring out that how does one go about investing with this background. So investing, the way I look at it, investing is very simple. Investing is a product of investment is as simple as the food item. The essential function of any food item is to provide nutrition to body, then provide energy, and then provide taste. But today, our food habits are driven completely by taste buds. What we eat depends on what we like eating. Whether it does have a nutrition value or not, it doesn't matter. Definitely COVID has changed something a little bit, but it's so much ingredient in our daily day-to-day activity that we are driven completely by a food which tastes very good on our tongue, but perhaps not useful for us for providing energy or nutrition. So we have forgotten the essential function of the food. Same thing happened in the investment. The essential function of investment, any investment product, is this. Number one is that the investment product should have safety. So safety of capital is the number one criteria when you look at investing in any instrument. You need to ask yourself, is this a safe investment? Is my capital safe in this investment? If this box is not ticked, then don't move to next box. Second come the question of liquidity, because investment is the postponement of current consumption, and the need of current consumption can come anytime in future. Need for consumption can come anytime in the future. So is your investment liquid enough to book profit and meet the requirement which you're looking forward? The second box is liquidity. The first box you need to tick is safety of the capital. Second box you need to tick is the liquidity. And only if these two boxes are ticked, then you need to look at the box of return. But as I told you, we first look at the return and then we look at anything else, and that destroy our mind share. So what happened that when you look at return, then you try to justify the lack of liquidity in the product. Then we try to justify why capital is not safe, because we need to take high risk to generate high return. It is not a right thing. High risk does not necessarily mean high return. There are way to get high return without exposing yourself to the high risk. So any investment product, one need to look at first safety of capital, second is liquidity of that instrument, and then only one need to look at the return. So when we look at examining safety of the capital, so what is the meaning of safety of the capital? You have money, you have a 2,000 rupees currency note. You can go and buy something from that 2,000 rupees currency note. So what you are looking to protect is the purchasing power of that 2,000 rupees currency note. You are not looking at physically protecting 2,000 rupees note. 2,000 rupees note is a promissory note only. What you're trying to protect is the purchasing power of that 2,000 rupees. So when you look at protecting capital in the long term, what we are really looking is protecting the purchasing power of the capital we have. So what is the risk to that purchasing power? The risk to that purchasing power is a rise in the prices. And rise in the prices means inflation. And what creates inflation? Inflation is created by the things which we are consuming. So inflation is like a Bhasmasur, which ourselves are creating. So let's see what you are consuming. When you get up first thing in the morning, we consume toothpaste, we consume bathroom item, we consume toiletries. When we go and eat breakfast, then we go to office, we use internet, we use vehicle, we use petrol. When we travel, we use airline industry, we use hotel industry, we take medicine, we go out and watch movies. So on an everyday, a single individual is exposed to close to 160 companies on daily basis. So the prices of product which we are consuming goes up. When the prices goes up, it means more money is taken out from a pocket. And where that money is going? That money is going into these companies. And where these companies are benefiting, how these companies are benefiting, these companies' profit grow. When this company's profit grows, it gets reflected in the share prices of that company over a long period of time. And how does this collectively get reflected? It collectively gets reflected in the Sensex or Nifty or any indices which you're tracking. So rise in the prices of the product which we are consuming get reflected ultimately in the movement of the Nifty and Sensex. So if you have to think for protecting your wealth from the long term, you need to think of investing in asset category where that asset category have a natural hedge against inflation. Real estate does have a natural hedge against inflation. Historically, we have seen that real estate does very well over a longer period of time, but real estates have its own challenges. One of the biggest challenge with real estate is the one need to consume large amount of money to start investing in real estate. Second is that it is not a very liquid asset category. Third, transaction cost is very high. Fourth is that it's subject to a lot of fraud, delays, and all kind of stuff. I don't need to talk too much about it because most of the people have burnt their finger in one or two ways investing in real estate. So real estate will continue to provide you good return, but it will remain liquid. And like any other asset category, it will also be very cyclical. So you have a 10-year period, boom period, then you have 10 period of bust period, which has happened to almost every asset category, including real estate. So real estate will look at expanding on and around the number of GDP. If GDP is growing at 4%, inflation is 4%, then 4 and 4 is 8%. 8% is the kind of growth you will see in the real estate over a longer period of time, subject to all these things which I have told. Gold is a one asset category which is completely driven by demand and supply. And gold has in recent past done phenomenally well, but there have been a period of 5, 5, 7, 7, 10, 10, even 20 year period where the gold has not delivered any investment performance. But in my opinion, gold has to be decent part of every investor's portfolio. And the best time to invest in the gold is when gold is not showing good investment performance. Most investors invest in any asset category when they see the recent past numbers are very good. Past 1 year return, past 3 years return, past 5 year returns look very, very attractive. Then that is the time investors started investing, and there's a lot of interest of investor in that particular investment option. But my suggestion to anybody listening on this broadcast to keep that in mind, the best way to invest is not to invest in asset category where the recent return has been very, very high, but look at the investment particular asset category, look at his long-term track record and figure out is the current investment performance is very different from the long-term track record. Either way, if it is too good, then avoid that particular asset category. If it is too bad, then examine and start exploring that particular investment category and start looking at investing. So that is the one thing people need to keep in mind. So in my opinion, India, what we have seen in last 10 years is very interesting. India GDP has expanded around 12 to 13%. But India's corporate profit has just expanded only 6% per annum. So we have seen GDP as a percentage of corporate profit as a percentage of GDP is around 20-year low. Today, total corporate profit as a percentage of India's GDP is below 3%. We have seen same kind of number in 2003-04. So for 15 years, GDP is expanded, but the corporate profit has went up and then it actually came down. And why it is so? It is very important to examine why this has happened. So I'll give you some very interesting take from my side why this is happening. So what has happened that in 1992, and then after many years, we start opening our economy. When we opened our economy, I don't know what we have been taught, and we bought that idea that let's go for the cheapest cost manufacturer across the globe. So in that process, what has happened that anything which could be mass produced was start producing in China. Anything which was the top end is start producing in the Western world. So if you look at your consumption pattern, you'll figure out that things which are lower end, you're buying from China. And now they're moving into higher end as well. And top end like watches or luxury items, the Western world is supplying. On our social media, the Western world is very heavy. One of the biggest spending item we have today is foreign holiday. Definitely COVID has put brake on that. Foreign holiday on an average, an Indian family would spend 5 to 10 lakh rupees per annum. And I don't think any Indian company makes significant gain in that. Sending kids abroad for education, which will cost anything between 50 lakh to 2 crore rupees. And millions of Indian students do go outside to get themselves educated. So what we have done in last 15, 20 years that our consumption pattern has become such that all manufacturing or provider of services of these products or services were not Indian companies, but international companies. Indian just become a trade partner. So if you want to buy something, you set up a plant in India, but you figure out that you could import something from China, it is turned out to be much cheaper. So we have become a colony of the world without being colonized in last 15, 16 years. Now the things are changing. Why things are changing today? 15 years back, we didn't have enough capacity to create a scale. Today we have a capacity. For instance, 15, 20 years back, the numbers of automobiles in India were consuming, the number of mobile phone India was consuming, the number of electronic items Indian were consuming was not that great in number today, but we have reached that scale. So today we have a scale. Second thing, 15 years back, we were a power deficit country. We didn't have power. Even if you want to produce something, we were a power deficit country. Today, no longer is the case. So we today have a scale. Now we have a skill and we have power as well. So now you will see India has lost out for last 15, 16 years on the manufacturing, and in turn has lost out on the corporate profitability. Rise in income level of Indian will get compensated going forward. COVID has fortunately provided us one very interesting opportunity. So going forward, I see for next 5, 7, 10 years, Very good for India, very good for Indian corporate, and very good for overall market, employment, business activity. So here is a very brief from my side, and then we can take some questions because people ask. Over to you.
Rahul sir?
Yes, Shivam. Yes,
sir. Yes, sir. You can carry on.
Shivam, have you prepared any of the questions for this thing?
Yes, sir. I have a few questions which I wanted to personally.
Then you can go ahead because I am not much upon in the investment aspect. That's the reason.
Okay. Vijay sir, I just wanted to ask you a simple question. Before anyone invests into mutual funds, what are the most important ratios that one must take into consideration? What are the important ratios?
So I am a trained chartered accountant, but I do not file my own income tax return. I have a professional help which I take. So my request to all the chartered accountant or anybody who is listening to this webinar, if it is a full-time job, go ahead and do it. If they're not, then first thing they need to look at is to identify a good financial advisor, which will help you in identifying and creating portfolio for you. That's the one part. The second part is that how do you go and identify which fund to invest, for argument, if that was the question perhaps you were alluding towards. Then if you look at any rating of any which comes in various media, they pick the highest performing fund. And my own research suggests that I looked at this data for ELS as a scheme for 15 and 20 years. And suppose somebody is invested in every year into the best performing scheme, or somebody who's invested in the worst performing scheme. Ultimately, over a 20-year period, the guy who's invested in past worst performing scheme did better than the guy who's invested in the best performing scheme. So these ratings create some illusion, optical illusion in people's mind. But my request you to look at, if you are looking at any mutual fund scheme, look at how consistently the performance of the mutual fund scheme has been, point number one. Also ask anybody who's giving this data that what has been the worst 1 year, 3 year, 5 year return of this scheme. What we end up seeing most of the time is that 1 year return, 5, 10, 20 years return. So for instance, HDFC equity fund have a 23-year track record, 24-year track record. That fund has delivered 19% CAGR for a 23, 24 years. So 1 lakh invested has become 60 lakh. But a lot of people don't know the fund house NAV fell more than 50% 3 times. The fund's NAV fell 30% at least 8 times. The fund's worst 1 year return has been 54% negative. The fund's worst 3 year return has been 30% negative. The fund's worst 5 year return has been 5% positive only CAGR. So when somebody recommending you any investment option, ask them what has been the worst 1, 3, 5 year performance of that particular fund. And if you are satisfied with that number, then only you should go ahead and look at investing.
Okay, sir, the next question that I have is, what are your views on index fund investments? Why is it that the expense ratio in such type of funds are comparatively lesser in comparison to other funds?
See, index fund, you don't need to do anything. You just buy index. So there's no effectively fund manager role in that. The fund manager can't decide how much to buy a particular share, how much percentage weightage should be given. He just go and blindly buy index. That is the role of index fund manager, index. So index fund manager invariably is operation guy. But when you look at actively managed fund, there's a fund manager involved, and the fund manager chooses which fund, which stock to buy, how much to buy, how much weightage to give, which stock not to buy in the portfolio. So there's a skill of fund manager, and that is the reason that the fund house which have actively managed fund invariably charges more in that fund. Index fund, you don't charge much, you charge 5, 10, 15, 20 basis points. So that is the reason that the difference in expenses. Globally, index fund has done better in last 5, 10, 20 years. India, the jury is still not out very clearly that which way the tide is going to turn, whether index fund will perform better than actively managed fund. We have even enough actively managed fund in India, which consistently has outperformed the underlying indices. So, but still, if somebody want to create a portfolio, I think 20 to 25% of someone's equity portfolio can be in the index fund.
Okay, sir. Sir, what are your views on the pharma sector currently?
See, we have started recommending pharma in October 2018. And our view was very clear, as I explained in this webinar, that when we looked at pharma return for 1 year, 3 years, 5 years, they were looking very bad. And we know that this industry is not going to die down, that the industry is going to bounce back because uh, uh, we will have in 5 year down the line, we'll have enough sick people in this country. And but with the rising income level and lack of exercise and the kind of lifestyle we have, extreme level of pollution, the consumption of pharma product will not going to go down. On the contrary, it is going to go up. And now pharma is just not limited to manufacturing medicine. You have healthcare companies, you have diagnostic companies, you have a health insurance company, all are part of pharma and healthcare. So my view on the pharma sector is very positive. Still, we have seen sharp rally last 3-4 months, but still we believe that it is just around 30-40% return has come. More return is going to come, but one need to be little patient and have a 5-year view and invest on regular basis in pharmas. And the pharma, in my opinion, would do very well. And please keep in mind that every bull market, the leadership is invariably very different. In year 2000, the leadership was technology company. In 2008, it was the infrastructure company. In 2018, it was the banking and financial services industries. 2020-22, the leadership is invariably going to be very different than what we have witnessed right now.
Sir, how do you see the cement and capital goods sector in the next 10 years post COVID-19?
See, cement sector will do well because it is also a focus area for the government of India, where I think they are looking at house for everyone. So lots of money would go in construction houses, and also India need to do huge work on infrastructure. So I'm very positive on cement stocks, cement companies, sorry. I'm not saying you should go and invest directly in any, that is not my forte, but cement is a good sector to look at. Cap goods, we have faced huge competition from China and other part of the world. But now perhaps with more and more duty protection is going to come by. And if the economy activity is going to revive, then cap goods is a one good area where one could look at it. But one need to be very, very patient, because in capital goods, what we have witnessed in last 10, 12 years is a complete wealth destruction, even the best of the names. So one need to be go company specific, identify good stock, and then track them much, much more closely than what you track, say, for instance, Asian Paints or HDFC Bank. Capital goods you need to track more closely, because Nestle or these companies are a little easier to track because we know the consumption pattern and all that. In these stocks, it is much more difficult. There's a government regulation, there's a duty protection, all these things comes into picture. But I think cap goods, slowly one could look at cap goods.
Okay, so the next question that I have is, what is your view on insurgent sector and NBFC?
See, insurance sector will do phenomenally well in India, because the penetration of health insurance, general insurance is very low in India. Except car, I don't think people go and insure their equipment, TV set, refrigerator. We don't insure anything. I don't think people insure gold, precious metal. So I think there's a huge scope for general insurance. Health insurance is going to go up further, because the COVID has made people aware about the potential challenges. And in my own experience, I have seen that people don't take enough health cover because they believe nothing is going to happen to them because they're young. But suddenly they figure out that they are 35, 40, and then after some time, it is very difficult to get health insurance. Second challenge is that a lot of people work for the companies and the company provide health insurance to these people. But post-retirement, when they need the health insurance the most, at that time, there's no company available to offer them. So I think more education awareness is going into people's houses, and I think insurance sector would do very well. NBFC will have lots of challenges uh, because for very simple reason that the COVID perhaps will had shaken people that we just can't go borrow and live on the borrowed EMI and then believe that life will be continued. I think people will be much more cautious in borrowing going forward. So NBFC, only select NBFC will do well. A lot of NBFC have lots of challenges on the balance sheet today, particularly those who are involved in wholesale lending. And now even in the retail lending, once the moratorium get over, I think you will see lots of challenges. And why you will see challenges? Because people have lost their jobs, salary has cut down. So if you find that 10 friend of you or you, 5, 7 are not paying, then there's no shame attached to not paying. Earlier it was the 1 out of 20, but today out of 20, 5, 6, 7, 8 people are the similar situation. Then they will raise their hand and say, we're not going to pay. So I think NBFC sector, except select NBFC, will remain a challenge in my opinion.
So, sir, any view on small and mid cap since I had started investing in SIP from 2015, but by 2018 I was having a profit of 30 to 35%, but now I'm in losses.
I would suggest any investor who's looking at investing, see, buy and hold would remain one of the best strategy to invest. But I think it is important you should not put your entire portfolio to just buy and hold. You also need to create a portfolio where you take profit out regularly. So how does one take profit out regularly? Either you could do a return-based strategy where you say, the moment I hit 10%, 12% CAGR on my portfolio, I'll take money out to that extent. That is the one way to look at it. Second way to look at is one could look at absolute market fundamental. Just don't go by one ratio, the P multiple. P multiple aggregate level have a meaning, but it is not the leading indicator because 80% of the time, the market remain in the above average valuation. It's very interesting from past databases if you see. So one need to look at PB, one need to look at dividend yield, we need to look at yield cap, market cap to GDP and historical return, and then come to a conclusion. I run a model. So that model in October 2017 at Nifty 10,200 completely exited from the market. Then the Nifty touched 12,500. But suppose my entire wealth was invested only on that basis, then I missed out on big rally from 10,200 to 12,500. And perhaps I would have entered after getting tired at 12,000 level. But that strategy has, in 1st April 2020, when the Nifty was below 8,000, allocated 60% to equity. So I'm saying that buy and hold should be one part of the portfolio. Fundamental driven strategy should be one part of the portfolio. Then this targeted return strategy should be one type of the portfolio. So you need to allocate your money in 3-4 buckets. No longer you can go for just one strategy, buy and hold. And I'm telling you why people are doing buy and hold. Because from 2000 to 2008, we have seen in India for 4-year bull market on the debt side. And from 2004 to 2008, we have seen one lifetime bull market on equity. That remain in the collective memory of the people. And because of that period, the return of fund houses for 15, 20 years are looking very good. Most of the return of the fund houses come from period from 93 to 99 and from 2004 to 2008. In last 7-8 years, the people are struggling with investment performance. So it is very important when you create a portfolio, it is important that you create a structure where you have different bucket, because nobody can predict future, what will happen in future. So, but your portfolio should not be dependent on any event. So my advice to all the investor or all the CA fraternity sitting here is to not to predict what will happen to any asset category, but prepare yourself for any eventuality. So the portfolio has to be constructed in such a way to achieve your goal of becoming millionaire faster.
So, which is a better option, growth or dividend payout?
dividend payouts does not make any sense at all. So I can give you 10 reasons. Don't go for dividend, simple reason, go for growth option.
Okay. So, sir, is the Nifty overvalued currently, according to you?
As I told you, very honestly, I can give you a clever answer, I can give you honest answer. The honest answer is nobody have any clue. Okay. Now let me give a clever answer. The clever answer is that the market is always future looking. People expect vaccine to come. People expect lockdown to get open up. People expect that the economy is going to come back, bounce back in one and a half year. The market is discounting the future. Today, there's no other alternate asset to go and invest. People are not investing in equity. In debt, net of tax returns are 3%. So where are you going to put money? You can't put money all into gold. So ultimately, people will put more money into liquidity. And that is the reason we are seeing this kind of situation. So my suggestion to anybody is nobody know what will happen. Nobody have any clue. In January 2020, if you ask anybody, will market touch 8,000? They will laugh at you. In March, suppose when the market was 8,000, everybody was saying that 6,000 ho jayega, and the market went up to 11,000. So if anybody give you any view, just do Google search and identify what they predicted 1 year back, 3 months back, 6 months back, 1 year back. We are expert in the market. We come and give gyan, but please be mindful that we have a checkered history, and that doesn't help an investor. So investors should not look at absolute nifty return or this and that or value or valuation. Investor need to look at how do I create my portfolio in a given situation, and how do I take advantage of expanding GDP, expanding corporate profit in India. And one need to create a proper structure around one's own financial goal to meet these objectives. There are more questions. Somebody want to ask? Hello.
Sir.
Yeah.
Anyone want to ask? Other, I do have some question. Sir.
See, Rahul ji, can give my.
I'm a chartered accountant. I do only auditing and bank audits, and never touched any of the aspect of share trading. Though I view many times scripts, try to follow.
I have written my mobile number, or people can contact me on my mobile number, or
yes, sure.
I'm writing my email address as well. So on the chat box, people can see that and can send their queries to me. I can address because I'm not able to address with the satisfaction currently.
Yes, sir.
Yeah, बोलिए sir, आप कुछ पूछ रहे थे.
Good afternoon, Vijay ji. Can you please let me know your view on the real estate REITs?
I think it is a very interesting and emerging area in the investing. I think one need to examine them and one need to nibble a little bit. So start buying in a small quantity, see how to perform. Because when the FD interest rate is effectively 3%, 4%, I think REIT could be a very interesting alternate. So it is a good idea to examine, especially where to invest, how to invest. You need to consult your financial advisor. Suppose you're already overexposed to real estate as exposure, then it's not a wise decision to expose yourself more into that asset category. So it is very important that you take up a very balanced portfolio, create a very balanced portfolio. But in general, my view is that it is a new area to examine, and one need to look at investing in a very small way, get the feet wet, and then move ahead.
Do you have any view on the gold bonds?
The sovereign gold bond is a very good idea. You will get a 2.5% interest. You also get capital gain tax free after 8 years. But the only challenge is that there's no liquidity for 8 years. So suppose you come for first 5 years at least. So suppose you're comfortable with that idea, then sovereign gold bond is a good idea to look at investing. But however, I would recommend you to look at gold not when the gold has delivered very good investment performance. You should look at investing in the gold when the gold returns are suboptimal or in negative territory. I'm not saying from 53,000 is not going to go to 60,000, 70,000. I don't have any clue. But the higher asset category goes up, the lower a probability of future return. So either you get return upfront or you get volatility upfront. When you get return upfront, it means that you're going to see volatility going forward. A better alternative than buying gold is to buy gold fund, gold mining companies fund. And the gold mining companies fund, when the gold prices goes down, they go down much sharper. And when the gold prices increases, they also rise much sharper. So when the gold prices are in bad shape, look at investing in gold mining companies. One or two funds are available in India. So look at investing in those. Second thing, you should also look at investing on regular basis to cut down the volatility. And the mutual fund, ETF or fund of fund provide excellent opportunity. And why I'm saying, because when you buy gold, you buy physical quantity. Suppose you buy 1 gram or 10 gram or 100 gram, whatever the number is, and you buy on regular basis. But when the prices are 4,000, you're only spending 4,000. When the price is 50,000, you spend 50,000. But suppose you buy a fixed amount, not fixed quantity, then the average cost is much, much lower. I have done a study for 15, 20 years, and you could do for anything. When you buy fixed quantity, the average cost is always higher. When you buy fixed amount, the average cost is always lower. So go for that strategy rather than buying physical gold, because physical gold, for every Indian male, there's a spouse available at home or working who does it for them. So you don't need to go too much into physical gold. Look at gold as a financial asset. Suppose you are buying as asset category.
Good evening, sir. My name is Girish. I have a query on the debt fund. Looking at the Franklin Templeton's closure of few funds.
Yeah.
Where is the good option for investing for short term, please? Thank you.
Currently in the current market, I think ultra short term of all fund houses except one or two fund houses in very good shape. You could look at investing in those products, but the YTM is around 5%. So you are going to get around 5% return in those products. But it still is better because this will come in form of capital gain for you. So you can adjust against short-term and long-term capital losses if you have any, or you can book to set off these gains from debt. So you could look at liquid is now 3%, 3.5%. So liquid doesn't make any sense investing. So instead of liquid, you should keep money in the bank account, much better. Saving account will give you 4%. But if you have money which is more than 1 month, then I think look at investing in ultra short duration fund. Suppose you have money for 6 months to 12 months, then look at investing in lower duration fund. Beyond that, don't look anything in the long term in the current environment. As far as Franklin Templeton schemes are concerned, it is a freakish incident, and it is a more of a comment on the lack of liquidity in the fixed income market in India. Equality is also a comment on the risk measurement and kind of things on Franklin Templeton. But I'm tracking that very carefully, and I write tweet every month whenever they disclose the portfolio and any important event happening. My sense is that most investors are going to get their money back in all 6 schemes of Franklin Templeton.
Thank you, sir.
Hello, sir. Vijay, sir. This is Rajan speaking. I have a very simple question. Actually, the reason behind this question is that my most of the equity portfolio is being covered by auto sector shares, and out of that, mainly Maruti. So what is happening that since last 4 years I'm into losses in Maruti, even though the prices are down, and even though I had average out also. So just want your opinion on the auto sector after the COVID situation. Do you really think that people are going to buy vehicles after this time? Your views, please. Thank you.
I think people will buy. And one very important factor in Indian auto companies that unlike global auto companies, company like Maruti is very cash rich. So the ability to withstand a COVID-like situation. So definitely when the economy is going to open up, I think you will see people buying vehicle. But long-term trend for auto industry, until they start focusing on export, the long-term trend on auto industry are not very good.
So the corporate bond funds are giving double-digit returns, even the funds with AAA holdings. So is it okay for investing it in now?
So I think you ask a very good question. Whenever you look at investing, people tend to look at what has been the immediate past return, and then they look at investing. So debt fund is the worst way to look at that way. If debt fund has delivered very good return, it means the yield or interest rate in the economy has come down. So suppose a fund house was holding 8% AAA 5-year maturity papers. And suppose interest rate in the economy comes down to the 7% or 6.5%. That is what happened in AAA bond. 1.5% multiplied by 5, 7.5% is the capital gain you get, and then 7% is yield you got. So you got 14% return in a 1 year time. But the YTM of the fund has fallen to 6.5%. Net of expenses, you're going to get 5% return from these bonds going forward, provided there's no movement in the interest rate. If the interest rate start inching upward, then whatever gain you've seen, start dipping into that and you will see some losses in the portfolio. So when you look at any debt fund, don't just look at the past return alone. You also need to look at what is the YTM. YTM basically tells you what is the FD rate. Suppose you go and buy FD, you look at iska FD rate kya chal raha hai, 6%, 5%. Just look at the YTM. Is available on the website of a fund house. It is available at various places. And ask a financial advisor to give you YTM. And now regulator is making it mandatory for fund house to give YTM script wise. So it will be much more easier for you to analyze. But that is a job you should, when your advisor come and tell you, yaar, ye double digit return aa gaya hai, I think the first thing you should do is to throw that advisor away, because that have no relevance of what is going to happen in future. Your future return would come from what is the YTM. So if I am an advisor, I'll tell you this is the historical return, but the YTM of this fund is 6.5%, expenses 1%, 5.5% you're going to get, provided you hold till 5 years. If the interest rate doesn't move upward, if interest rate move upward, then you will see some losses in the portfolio. But in 5 year time, you're going to get 5.5% compounded return. So that is a thing you need to see in debt funds.
So the next question that I have is is it enough to look at valuation of a prospective company for investing per SE using methods like discounted cash flow, growth, etc., or you advise some more parameters to look at it?
See, suppose it is a question coming from the student, then I can answer that. But suppose it's coming from the market participant, then it is very difficult question to answer, because to student you can answer a theoretical question through theory, but the market dynamics are much different. So discounted cash flow is the only way to analyze businesses, and it will tell you how the cash has been efficiently utilized. Equity market is a place where you are rewarded for efficient allocation of capital. And one of the good parameters to look at the discounted cash flow of the businesses, discounted EPS of the businesses. Pure P multiple does not mean anything. For instance, let's look at auto company. If the auto company had just dispatched its vehicles to dealer and shown this as a sales and also inventory, then definitely the book value will look very good. The EPS will look very good, but actual sales has not happened because the cash has not come in. So in this kind of situation is very important to look at discounted cash flow, but market reward, not just the cash flow, but what is the future outlook. One need to look at it. And before one start analyzing P&L, one need to analyze the balance sheet, because if you buy a strong company, even you bought at the little higher price, there's a very low possibility that you may lose capital. Perhaps the return will be much lower. But suppose you invested in the company with a broken balance sheet, the broken balance sheet take much, much longer to repair. A P&L which was showing 200 crore losses can be 100 crore profit next year. It doesn't take much time. But the broken balance sheet take lots of time to repair. So before you analyze understanding P&L, please start understanding the balance sheet of the company. What is a working capital cycle? How is the debtor management? How are the related party transaction? How the directors are compensation? What are the compensated? How they are paying taxes? What is the dividend policy? All these things parameter one need to look at it. But please keep in mind, in business of investing, there are theories, and theories keep changing. Benjamin Graham had a theory. This theory perhaps doesn't work that longer, because you don't get great company available at 15 PE multiple in today's market. Today market is rewarding growth. It is not rewarding value. So I have seen many investors getting in this value trap. So for instance, lots of people start buying MTNL. A lot of my friend bought MTNL. यार इनके पास इतना property है, इसका market cap तो कुछ भी नहीं है. People went and bought Century. People went and bought Bombay Tank. People went and bought Hindustan Motor. Just looking at the value market cap and saying उनका real estate ही बहुत ज़्यादा है. जब अनलॉक होगा तो सब पैसा पड़ जाएगा. ऐसा होता नहीं है. Market doesn't reward these kind of company. Market reward growth. Market reward clean companies. So one need to have experience actually working in the market to figure out how market reward these companies. So apparently on a piece of paper, two companies may look alike, but the valuation could differ dramatically in the real market.
Sir, what is in shares of and what is preferred bank, private or the nationalized bank?
See, I have a little interesting take on the banking. Today, if you look at the leading bank like Kotak and Axis Bank, Kotak Bank and HDFC Bank, there's a huge premium going on for these organizations. But interesting part you see is that when you read their comments of their promoters or their senior guys, they don't want to take any risk currently. So I don't know how the shareholders will get rewarded going forward. Perhaps people say you want to stay in the safer hands, so perhaps people will stay in the safer hand. So it is a very interesting challenge. Banking is no longer the old way of banking. Okay, so one need to look at the cost of fund of these organizations. One also need to look what is the NIM, how efficiently the workforce being utilized, how are they gaining or losing market share, what is the loan book, whether it is more retail, within retail, what is the geographical diversification, all kind of things one need to see. So it is just not between public and private. Even SBI at the right price can be very good way of owning, because they have a card company, they have insurance company, they have asset management company. So it's just not that is public and private. So in public, one could look at SBI, provided one gets the right price to own. And in private, I think most of the banks are valued very, very highly, in my opinion. So one need to be very careful. Perhaps some small banks which are doing very well could be part of the customer's portfolio. The problem with leading bank is that they are so big in the Nifty. If there's a continuous buying from Ep-04 or FI, then there's a continuous buying of the shares of these companies. So you can't even short these stocks because there's a buying happening automatically. But in my opinion, I would rather avoid these big banks currently.
Also, sir, I'd like to ask you, what are your views on the aviation sector currently? What do you think is the future of aviation?
It is a bit challenge. I think till vaccine is identified, aviation will remain a challenge, because people, only those who have an urgent need to travel would travel. Else, traveling for holidays and the way the old we used to travel will become a challenge. The only good part in the aviation is that the fuel prices has come down and the employee cost has also come down and interest rate has come down. So most of these are on leases. So I think that there'll be cost saving, but until and unless we see top line growing, it will remain a challenge. And how long they will remain like this, only time will tell. So today I will not touch currently. When the situation emerges, perhaps we'll look at investing. So it is better to own something at 10 or 20% higher if you see little more conviction and visibility than just blindly buying because it has gone down so ultimately people will travel, so we'll make money in the process. That is not how the fund industry actually works.
Okay. Vijay, can I ask a question?
पूछिए सर. हाँ पूछिए.
Do you feel there is a disconnect between current status of economy and the market? And if there is any disconnect, then how long it will continue?
Shivji, we are living in a very, very challenging time, very honestly. And it is not discussed in any book or any theory or any college or university. In our collective memory or history, perhaps we are living first time in the zero interest rate and negative interest rate scenario. In that kind of scenario, how does one price an asset category? There's the one part. The second part, there's a very interesting economic theory which says that if the central bank print money, then it will be inflationary because the money will reach out to people and people will buy goods and services. Today, when the money is getting printed, that money is not getting into buying goods and services, but that is getting into buying assets. So GSEC, people bought GSEC, the asset prices come down. People bought precious metal, the prices skyrocketed, and people are buying equities. So it could remain irrational much longer. And as per my information, US government have $1.6 trillion with the Fed Reserve. So they are going to pump in money on continuous basis. They are not going to go away from these levels. If you look at in India, we have 8,000 crore SIP book. We have close to 3,000 EPFO money. Then we have NPS money. We have money coming from insurance company. All that, and then FI will buy index. So all these become very, and unfortunately or fortunately, what is happening that big part of the money which earlier used to go and buy property and paying EMI, that has completely disappeared. So whatever money you have, what do you do? You put an FD, or where you put the money? So the money on continuous basis is getting feeding into equity market. So it's very difficult to fight liquidity. And people are now today not even counting 2021 earning. They are counting 2022 and 23 earning. It's a very challenging market. Suppose you and me, people who are a market participant, as what to do. So I follow a very simple strategy. Certain part of my portfolio and buy and hold. Certain part of my portfolio, I do this fixed return target, return strategy. Certain part of my portfolio, zero risk equity portfolio, where I put money in a debt, and then only interest is being fed into equities. So I do these kind of things, and I do the value STP. So I invest, say, a fixed amount every month, but if the market fall, I invest more, and the market rise, I invest less. So one need to find his own way to handle this market. So I can't answer your question, in a very clear term, but because today is a very challenging market, so the one need to structure one portfolio around these challenges.
Sir, one question I have is, in fact, two questions. One is the most of the Nifty gains is due to just one stock, Reliance. So what is your view on Reliance? Second is, now a lot of robot advisors are also coming in, and they are replacing the human advisors, and a lot of fund houses are also launching them. So what is your view on because they follow the algorithmic way of investing?
So Reliance, I don't think I have any view on Reliance, and but what will happen? Let's see what will happen, Reliance.
So there's a question from Chitresh Soni. He says, why does IndusInd Bank head every fall and every rise? Why is it so volatile?
Okay, I'll come to that later, but
Yes,
I'll
yes.
first answer
Shivam,
your.
you are cut short actually, Vijay sir.
So
So sorry for that,
I'll
sir.
answer first your Reliance wala question. Uh, See, Reliance is a very interesting situation. If the index money is coming, then it continue to get feeded into Reliance. But in mutual fund, we have more than 8 lakh crore of asset in diversified equity mutual fund. There, any new money will not get invested in Reliance because in any mutual fund scheme, no stock can be more than 10%. You can break that limit passively, you can't break that limit actively. It means that suppose you're owning it 9% and because of valuation gain is go about 10% is fine. But once it crosses 10%, you can't invest a single paisa in that particular stock. So if a mutual fund new money will not get invested in the Reliance, that one need to be very, very clear. But EPFO or index money will continue to get invested in the Reliance stock. And Reliance, I don't think anybody in the mutual fund industry claim they understand it well. It is a very difficult company to understand. So I don't have any comment. Suppose I'm a fund manager, my request to all the fund managers most of the time has been in Reliance, you go equal weightage. You try to understand other companies, but don't try to understand Reliance. It is too big in the index. So, so that is one part. The second part was the question you asked about.
Robot advisors.
So robo advisor will come and they will come and they will go. But I think please understand in investing, the most important part is action. And the action, somebody come and tell investor to take action. For instance, just look at health insurance. How do you buy health insurance? You need to buy health insurance from someone where your family knows that person. Because if anything happens to you, your spouses, your kids should know whom to contact for insurance. So there's always human intervention involved. When you grow your wealth to decent level, then you need hand holding. Investing is a lonely business. So you may get completely blinded by your view. You need someone experienced to tell you, okay, you're going with that view, but don't go 10%, don't go 50% your portfolio and that kind. Like one gentleman spoke, his single holding is Maruti. Suppose I have to advise him, I'll never advise for single stock portfolio at all because it can be extremely risky. So when somebody does directly, somebody does to robo advise, the challenge is that in a critical time, they don't know how to help these people. And this robo advisory goes on past data. Or suppose you go by past data that this much allocation has to go in equity. In last 4 year equity market remain at the higher P multiple. So does it mean you remain zero in equity? Even in April 2000 when the Nifty was below 8,000, the P multiple was 22, higher than the normal market P multiple. So it will remain a challenge in my opinion. It is a good talking point, but how much money of investor is being routed through robo advisory is not even big in USA. So I don't know how much is going to catch up in India. And the question on IndusInd, very difficult to answer that question. Maybe because people don't enough strength in the bank's numbers, maybe the change in leadership. So it is gone into hand of a speculator, perhaps, and speculator speculate what other speculators are speculating. So when they're rising, other speculators will just go and buy. When it's falling, other speculators say, let's go and sell. So this is what is happening on that particular stock currently.
So there's a question from Arvind. He says, can you explain how chain trading goes and how they cheat real investors, just for knowledge?
How, what?
Sir, chain trading, how chain trading goes. Chain trading.
I don't think it's a forum I should answer this question. So ask gentlemen to call me privately.
Definitely, sir. Yeah. Rahul, sir, if you have any questions.
So there are some queries on our YouTube channel. What are the future instruments of investment like cryptocurrency?
Not yet. So, see, look at what has worked in last 25, 30, 50 years. Cryptocurrency, I don't know how it will work, how many people understand it, but it's very interesting because a new concept and when somebody invests in cryptocurrency, you can go and tell people. So it's become a very good tool to impress people socially. Return, it will come or it will not come, God knows. So I will not indulge into that kind of thing currently. Let's see how it get develop over a period of time. Or no central government is going to give away their currency to any third party. Let's be very clear about it. Japan is trying very hard because Japan has lost out. Earlier it was a British pound, then the US dollar. Now Chinese currency is dominating the world. The Japanese are figuring a way out that how do we can go and create our space in the global currency space. So I think it is that kind of situation happening.
I think
Another
cryptocurrency is banned in India, no, sir?
Yes.
And secondly, algo trading. What are your views, sir? Algo trading. The people deal into the algo trading.
So algo trading is not as sophisticated as there in the global market, and they work on very thin margin. But India, it is not, in my opinion, good for the common investor to indulge into it. They work on thin spread, thin margin, and they are looking most of the time debt plus kind of return. So it is not some area where you need to break your head too much into it.
Okay.
Another question is, in the beginning, which sector we should target to invest in share market?
I think first you should invest in index fund, then invest in a decent open-ended mutual fund. Then look at investing only 10 to 20% of the portfolio in the sector which is into deep red, and you believe enough reason that the sector will recover, then look at investing in that particular sector. If the sector has done very well, then you have to be a little careful investing in that sector.
So very well said. And for advice, like persons, like few of the chartered accountants like me, means who purely are into audits only and banking and either this audit or this work, and they don't look after to any of these shares, and they give to some of the XYZ person, and he bullshit. Sorry, I shouldn't be saying, but he scraps of his all of the capital that day, and then he never thinks of any time to go and invest in this kind of shares. What is the advice to such kind of people?
See, my most challenging customer has been chartered accountant to convince. But once they come on the board, they are the most easiest to handle. Because CA think that nobody is better than them when it comes to numbers. I have my friends who are CFO finance, who are director finance, my CEO guys. MBA guys are easy to deal, doctors are very easy to deal. But when it comes to chartered accountant, they just don't believe that anybody can do better than them. So one of the worst portfolio I see are of practicing chartered accountant, unfortunately, but it's true. Either they are into direct trading, they are into direct stocks, they don't have a proper plan, they don't have a proper strategy to invest. And they say, ye chor hai, wo chor hai, ye chor hai, wo chor. I hear this every day from, so CAs being a successful investor, in my opinion, is a very different thing for a chartered accountant to be a successful investor. They understand everything. So they understand the price of everything. Whether they understand the value of everything, I don't know. So in my opinion, that is a challenge. And perhaps they won't create balance sheets. So they don't trust any other person's balance sheet. Maybe that is the reason, because we know what happened to small companies' balance sheets and what kind of things happen. But everything is not that bad. I'm into investing business for 25 years plus, and I've seen 15%, 20% CAGR in the portfolio. Not very difficult to get. Going forward, the return will come down. So in my opinion, the first step one need to do is to hire a good financial advisor. It is just not which fund to invest and which stock to invest. That will not drive a return. I'll give a stock which will double in 3 months' time. But that is not the question. The question is your wealth. that wealth need to grow at certain percentage for 20 years, 25 years? That is a question you need to ask yourself. How are you going to address that question? But most of the time when I do webinar or meeting with CA, कौन सा stock अच्छा लग रहा है, कौन सा sector अच्छा लग रहा है, यहाँ ज़्यादा पैसा जल्दी बन जाएगा. जल्दी पैसा किधर नहीं बनता है. पैसा धीरे ही बनता है, लंबा बड़ा पैसा धीरे ही बनता है. So Warren Buffett से किसी ने पूछा कि why not so many people are rich, and he replied because people don't want to grow rich over a longer period of time. They don't have patience. So I think देखो इक्विटी मार्केट में 8-8 साल का साइकिल चलता है, रिटर्न 3 साल में आता है, 5 साल में रिटर्न नहीं आता है, लेकिन 5 साल में आपका एडवाइजर का जॉब भी आपको रोक करेगा तो आपको 3 साल भी दिख जाए. So in my opinion, for instance, if you look at PV Sandhu, who is the top badminton player in India, she got a badminton coach, she got a nutrition, she got a physical exercise coach, and she got a conditioning coach. She got 4-5 coaches. Someone who's the top of a game internationally take help from 4 people. So
yes, sir. Got your answer that one cannot be suffice everything, but yes, certainly we need to diversify ourselves, right?
yes,
if I'm not wrong.
that's absolutely.
Another questions on board. Shivam, can you take some of the questions on board? But meanwhile, just let me allow to ask another. Sir, that as we know what kind of investments, there are various kind of investments. But then, what should be the portion or what should be the compartment they should be making while making investment? Say it is real estate, say it is gold, say it is FD, say it is your insurances and any other sector.
See, I tell you,
what should be the ideally?
So I tell you, for instance, first of it all lot depend on how predictable are your cash flows are. If you predict your cash flows are more predictable, then you can go into a different asset category, or you may take more real estate, you may take more equity exposure. It also depend on your own temperament, like whether you can take volatility in the portfolio, what happens to you at that time. Also depend on your family structure, or how many people are dependent on you. If you have more people are dependent on you and cash flow is unpredictable, then it is not good for you to take riskier asset category, illiquid asset category. So it lot depend on a person's background. Then only one person's portfolio can be created. But a 12th century philosopher once said, a person should invest 1/3 of his asset into land, 1/3 into enterprises, and 1/3 into fixed. So you can keep like that, but it is just a general statement, but it is not a rule for everybody. Everybody need a different kind of prescription. So it is very important that either you apply your mind to understand all these things and then create a portfolio, or read about it. Is enough material available in the market.
Sir, there's one question from Girish Pathak. He says, what are your views on the telecom sector for the next 5 to 10 years?
You have a Geo one side. It's very difficult to fight against Geo.
Okay.
So good evening. If you permit me, I have a question. Ramesh here.
Yeah, sure.
Yeah, sir, this is regarding, I have a regular EMI which I have to pay for next 3 years. But since I was not saving anything, I took advantage of this moratorium, and 3 months EMI I have saved. So, sir, my right now I have saving, and my question is, so where should I invest this saving so that after 3 years, I'm able to compensate my interest which I have to pay on my loan. So if by saving this EMI, I'll be paying 30% over 3 years. So my target is to achieve 30% over 3 years. But I'm confused, where do I save it?
50%, 3 years impossible to get with surety.
Okay. Okay. So I should avoid the market, right?
If you have money, pay the loan.
Yeah. All right. All right. All right, sir. Thanks.
Sir, so the CA do CFP. Most of the CFPs are working for different brokers. So how to find a good trustworthy independent CFP?
You need to experiment with few people. Then only you will get to know. So start with a small amount with somebody. एक सिंपल रूल बताओ कि जब आपको वो इन्वेस्टमेंट बताने आता है तो रिटर्न बताता है, रिस्क के साथ में बताता है. I think that's a very good test of a good advisor. If the advisor is not telling you risk in the product, then it is not a good advisor. A simple logic. Because आपकी इन्वेस्टमेंट की जर्नी में रिस्क वॉलेटिलिटी आएगी. अगर वो आपको एडवाइजर नहीं बराबर बता रहा तो मतलब उसको खुद को समझ में नहीं आ रहा फिर. और सेकंड थिंग, क्या वो आपको चीज बता रहा है उसमें खुद का पैसा भी डाल रहा है कि नहीं डाल रहा है?
Yes, sir.
आप दो चीज देख लो, सिंपल.
Yes, sir. Got it.
If anybody need help, you can give my number, they can contact me.
Sure, sir. Rahul sir, any questions?
No, I'll be your first person to call you. Render your services. So I guess very wonderful show, Shivam. So let's
Yes, sir.
proceed further for vote of thanks. And would you mind, Shivam? Or
Sir,
shall I give you
you can proceed
closing
further,
remarks?
sir. Yes, sir.
Okay,
You
fine.
can
No
proceed
issues.
further for the
Okay,
vote of
fine.
thanks.
Fine. Thank you. First of all, Vijay sir, for so much doubt solving session. Means our 30 minutes quick session was like whole recap of the COVID and the economy. Then all sort of coverage when we speak of gold, even if you speak of mutual funds, even if we speak of equity, other kind of investment liquidity, each and every ratios. Means that 30-minute session is like a brief intro. Anyone listens who will get quick insights of each and everything what present scenario is before investing. And then fortunately afterwards the question answer session, that whole audience were into their doubt solving, and each and every question is being answered very beautifully and without any hesitation and something or so. And really it was wonderful session that we could have you over here. Means we have seen you on watching on the TV, but seeing in our webinar, definitely it was, and interacting with you was very interesting. And this will be good for all people before investing, how to go about, where to go about, and how to go about. So all these things have been answered today. So Vijay sir, thank you for coming for Thane Vikasa. Students will definitely learn out of it, because at early age what mistakes people do, and then think that no, market is not my cup of tea, like I said. Similarly, these people will never do such kind of errors in future when they start in investing in market. So thank you, Vijay sir, once again on behalf of Thane Vikasa, on behalf of Thane branch and everyone, because members are even present today for your this quick session of multi-millionaire. And thank you once again, audience, for with your good questions. This could not have been great session. Okay, thank you once again.
Thank you.
Thank you, sir.
Everybody. Thank you.
Yes, Shivam. Good job.
Yes, sir. So, sir, shall we stay here, or shall I
No,
end
I'll
this
just
meeting?
I'll just share the this thing that in AS which we have started on 1st of August, and we are joint program with tax friends, so people can just take benefit of this Ind AS. People, friends, you can join for Ind AS. It's been started 1st of August. though it is 300, but for students, we have done it for 150 rupees. So please enjoy the program of IND AS that will be till 30th of September 2020. Thank you.